Hi, my name is John McCalloch. I'm a chartered accountant, a chartered management accountant, and I've taught accounting at University College Dublin for more than 30 years. My specialist subject is analysing company financial statements, and this video is one in a series of videos about how to analyse revenue recognition. That is, how to understand how the company is recording its revenue and the implications of that for forecasts of future revenue, and looking at current revenue in terms of how much subjectivity is there in there, and also how well aligned it's going to be with the economic reality of the firm. Okay, so let's have a look at these series of videos. The first video was Introduction to Analyzing Revenue Recognition. If you're not familiar with the terminology of revenue recognition, then I think you should go and watch this video first. It goes through all the terminology, and then it does some very simple examples about revenue recognition, and also covers where you're going to get information in the financial statements about revenue recognition. This video, analyzing physical goods revenue, does a deep dive into physical goods. And the complication here is not really the physical goods, but the things that go along with the physical goods. And we'll get stuck into that in a minute. I want to make a disclaimer. The video and slides are provided as an educational service. They should not be used as investment advice. I use company accounts here as examples of accounting issues and the solution to those accounting issues. There is absolutely no intention to criticize the companies or to say that anything that they're doing is at all wrong. The examples are just used as illustrative examples. Thank you. Right, revenue from physical goods. So revenue from physical goods is generally recognized when the goods are delivered to the customer or the customer takes control of the goods. At that stage, generally speaking, what happens in accounting terms is we can record the revenue. Our performance obligation of providing the goods has been satisfied. We can record the obligation, and either we get cash from the customer or we record a receivable and the customer pays us at a later date. Now, the complexities come in when the physical goods are supplied along with other things. And what about when the goods are in a contract with the customer, as well as things like warranties, loyalty points, gift cards, whether there's a right of return for these physical goods, rebates. So if you buy a lot of these physical goods, or if your customer buys a lot of those physical goods, do you owe them a discount if they exceed certain sales targets? And also service contracts can go along with physical goods as well. And sometimes subscriptions and licenses and all kinds of different things. So this leads to a certain amount of complexity in revenue recognition. And that's what we're going to look at. We're going to look at essentially a couple of examples of physical goods that are associated with these kind of other services. Okay, so let's suppose that a shop provides a free €10 gift card with every €100 purchase. What are the shop's performance obligations? Well, the first one is to provide the goods, and that seems straightforward enough. When the goods are provided to the customer, then we have satisfied that performance obligation. The second one is to provide some sort of goods or services in exchange for the gift card. Now, this is a distinct performance obligation from the first one So we are going to record it at a different time when we actually provide the goods and services in exchange for the gift card. We covered a very similar situation to this in the first video, introduction to analyzing revenue recognition, where we looked at loyalty points. So for the first performance obligation, we recognize revenue at a point in time when the goods have been provided. And for the second one, we recognize revenue at another point in time when the gift card has been cashed in or used up and we have provided something in exchange for that, and that has satisfied our second performance obligation. So revenue from the gift card is not included in the revenue now when we make the original sale, but deferred until the gift card is used. And that's why sometimes you will see the terminology in balance sheets, deferred revenue or deferred income. The more modern terminology for it is contract liabilities. And what we should do is when the original sale happens, we record the revenue for the physical good, and we hold back the revenue from the gift card, and we do that by creating a contract liability on the balance sheet for which essentially represents the obligation to provide something in exchange for the gift card. So, supposing we get the cash in year one for the gift card, but it's only exchanged for goods or services in year two. Well, in year one, we are going to record the cash. That's going to go into our bank balance. We will record a contract liability at the year end, which reflects our obligation to provide something in exchange for the gift card. And then we will recognize the revenue when the gift card is actually used. So companies that sell a lot of gift cards are going to have large liabilities on their balance sheets, their statements of financial position, that represent that obligation. So let's look at M&S's balance sheet. Marks and Spencer's, a big retail group in the UK, and they have got trade and payables of 2.3 billion. That's made up of various things. One of the things that it's made up of is 215 million, which are contract liabilities from gift card sales. And what does this represent? It means customers have bought gift cards to the tune of 215 million that have not yet been used up. So they remain a liability until they're used up, and every time we sell new gift cards, we increase that liability and we decrease it when the gift cards are cashed in. So for example one, the gift cards, let's look at a few things that are happening here and how we would analyze the situation. How is revenue turning into cash? Well, for the gift cards, cash is being received before revenue is recognized. So we get the cash first, and then we recognize the revenue when the gift card is actually exchanged for goods and services. So that means that when we sell gift cards, there's an extra cash inflow into whatever accounting period we sell the gift card in, and we'll have a change in the gift card contract liability. So in Marks and Spencer's case, on the last slide, we saw that they have a contract liability of 215 million this year. It was 203 million last year, which means there's been a net inflow from gift cards of 11.9 million into our cash that hasn't been recorded in revenue yet. And then a second question, and these questions I introduced in the introductory video of this series. Are there any significant management judgments about this whole system of gift cards and contract liabilities? Well, not really. If the system to track gift cards is working properly, then everything's fine. Maybe there might be some issues with gift cards that have been outstanding for a long time. Sometimes companies have policies that kind of cancel gift cards when they've been outstanding for a long time. And then other companies, they have indefinite lives. So we might have to have some kind of policy as to what we do if a gift card has been outstanding for 5 years and has not been cashed in. Can we at that point recognize the revenue from the gift card? And different companies will have different policies on that depending on the reality of the conditions that they sell their gift cards under. Let's have a quick look at the kind of companies that have a lot of contract liabilities on their balance sheet. This is a graphic that I developed from data on Bloomberg for the Stock 600 Europe index. So that's the biggest 600 listed companies in Europe. And you can see here that this is the median. The median for the software and services industry is about 15%, and some of those companies have as much as nearly 30% of their revenue on balance sheet as contract liabilities. This makes a certain amount of sense, as these companies, they have subscription models, maybe long-term subscriptions, where they receive money in advance for services. Sometimes they receive money in advance from upgrades and maintenance that they're going to provide in the future. Other companies that have a lot of, or other industries that have a lot of contract liabilities, the capital goods industry. Here we might get deposits, we might get cash payments in advance for constructing some kind of large goods or construction projects, technology, hardware and equipment. So again, we can have service contracts and other things that we're promising to provide along with our hardware and equipment. So that gives you a quick look at the kind of companies that have contract liabilities on their balance sheets. So now we're going to look at example 2, which is going to be a lot more complicated than the revenue recognition situations that we've seen so far. So a telecoms company has a contract to provide a phone, a physical product, and 24 months of telecom service. And we're pretty much, all of us are familiar with these kind of contracts that you get from telecoms companies. So what are the phone companies' performance obligations? Let's look at that first. Well, the first one is to provide the phone. They've got to provide the physical product of the phone. The second one is to provide telecom service for 24 months. And the cash flow for that will come in over the 24 months. Those phone and service obligations are distinct. You could sell them both separately. They don't have to be together. And for the first one, providing the phone, we recognize revenue at a point in time when the phone is provided. So when the customer actually gets the phone. And for the service revenue, we recognize revenue over the service period. When we perform a month of service for the phone user, then we can recognize that revenue for that performance obligation. They come in a series, so we have month 1, month 2, month 3, month 4, where we're recognizing the same revenue each month. So how does this work? Well, let's look at Vodafone as a real example of this. Revenue when the group enters into an agreement with the customer, goods and services deliverable under a contract are identified as separate performance obligations. So they're telling us they're separating them out, as we saw in the last diagram, to the extent that the customer can benefit from the goods or services on their own. And the separate goods and services are considered distinct. So we saw that in the last diagram. The transaction price is allocated between the identified obligations according to the relative standalone selling prices of the obligations. Fair enough. Where standalone selling prices are not directly observable, we use estimates. Okay. Revenue for device sales to end customers is recognized when the device is delivered to the customer. Okay, so when we deliver the phone, we are going to recognize the revenue for that phone. And remember, this is going to be on the basis of standalone selling price. So if a telecoms company like Vodafone are giving you a phone where the standalone selling price is 1,000 and they're giving that to you for, let's say, 700, then they will be recognizing 1,000 as revenue. And then this is about device sales made to intermediaries. If control of the device has been transferred to the intermediary. Remember, somebody like Vodafone is going to have a lot of resellers of their contracts and the phone. And as long as the device has been transferred to the intermediary and the intermediary has no right to return, then we recognize the revenue. Otherwise, we wait until the device is sent to an end customer. All of this seems very reasonable in terms of a revenue recognition policy. So let's look at a numeric example here. I think it'll make what I'm trying to say about how this contract is dealt with a lot clearer. So let's say we have a contract with the customer. We give them a phone and they pay €760. The standalone selling price of the phone is €1,000. This means we have a subsidy of 240. So we have subsidized the phone by 240. The standalone selling price of the services are 35 per month, but we charge 45 per month. And what we do is we allocate all of the revenue that we're going to get on the basis of standalone selling prices. So in month one, when the customer gets the phone, we show revenue from the phone of 1,000 and revenue from the service contract of 35, and in every month then we show revenue of 35. Now the cash flow in month one is 760 from the phone and 45 from the service contract. Let's assume that they get this contract on the first day of month one. The cash flow is not directly relevant to what we recognize. We've recognized these figures up here as revenue. And this means we're going to have a contract asset in the balance sheet. And that starts off as 240, which is the phone subsidy. And we will decrease this contract asset by €10 each month. And the €10 is the difference between the standalone selling price of the service and the contract price for the service. So that €10 relates to those two figures up there. So what does that contract asset represent? Well, it represents the fact that we have taken revenue in advance of €240, and then each month the cash flow is greater than the revenue we take. So that reduces the contract asset as we go through the months. And you can see, after month 3, let's suppose that was the year end. After year 3, we would end up with €210 on the balance sheet, or the statement of financial position, if you want to call it that, at that point. Okay, so I hope that example makes things a little bit clearer as to how this revenue recognition works. So what's the real position here? Well, the real position is that Vodafone have 2.4 billion of contract assets in their balance sheet. Those are within current assets. In fact, there's a bit more in non-current assets that we'll see in a minute. And what do they say about this? Where we have provided a service and recognized the revenue but do not yet have a right to receive payment. So these cash flows of €45 per month, they don't have a right to receive payment on those until the month actually comes around and they provide the service. But they've already recognized some revenue from the phone, which was subsidized. So that this is the situation that they're talking about. So they say when revenue recognized in respect of a customer contract exceeds amounts received or receivable from the customer at the time a contract asset is recognized, contract assets will typically be recognized for handsets or other equipment provided to customers where payment is recovered by the group via future service fees. So this is what we're talking about. That once the amount becomes conditional only on the passage of time, the asset becomes a trade receivable. So once we get to the end of the month and we've provided the service or we have satisfied our performance obligation, and the customer owes us that money, then it becomes a receivable and it's not in contract assets anymore. So that's an important point. So trade receivables represent amounts owed by customers where the right to receive payment is conditional only on the passage of time. So we just have to wait for the customer to pay us. So that's receivables. Trade receivables that are recovered in installments are discounted at market rates. Let's not worry too much about that. Other trade receivables do not carry any interest and are stated at normal value. Okay, so we've got our trade receivables there within current assets. There's some are held at fair value. Let's not worry too much about that. And the bulk of them are just ordinary trade receivables where we have billed the customer and we're just waiting for the money to come in, and that's 3.2 billion there. One other thing about trade receivables, which is not it's not directly relevant to or it's not exactly revenue recognition, but the carrying value of all trade receivables, contract assets, and finance lease receivables is reduced by allowances for lifetime estimated credit losses. So, we always have to keep an eye on the fact that some of our customers are not going to pay us, and we have to make an allowance for that. But that's a bit different to the revenue recognition that we're talking about. So how do we satisfy ourselves that revenue recognition is working in a fairly complicated type of situation like this? Well, I guess we've got to look at the revenue and also look at what's on the balance sheet. And you can see here we've got the current assets here. I'm not showing you the non-current assets. That's receivables and receivables at fair value. These are contract assets down here. I'll just say a word about contract related costs because it might, confuse you a little bit. What they are costs that have been capitalized from acquiring some of these customer contracts. This is usually to do with commission and stuff like that. It doesn't concern us here for revenue recognition, so we can forget about it. It's a story for another day or maybe another video. So let's not worry about that. And then there's other receivables down here as well, which are not maybe to do with trade and revenue. Okay, so what do we do? Well, one of the things that I like to do is compare cash to revenue. and maybe see how the pattern of that is going over a number of years. I'll just do it for 1 year here. And we know certain things. We look at the receivables figure here. They went from 2.8 million to 3.2 billion. What is that telling us? Well, it's telling us that, 395 million of the receivables has increased by 395 million over the year. Well, what that means is included in our revenue is 395 million of receivables that haven't been paid for yet. So that is not going to be in cash. So what I do is I subtract the 395 million from revenue to get closer to a cash figure. This is the same logic as you would use to prepare a cash flow statement. I do have a video on that if you want to look it up and look up this logic. And I applied this logic to the other items as well, the fair value receivables and the contract assets. Remind ourselves what the contract assets are. The contract assets are essentially the phone subsidies that we have given to customers at the start of their contract that are gradually decreasing as we're getting in, increased cash flow from these customers to reward us for subsidizing their phone. So these have gone up slightly, I think by 60 million. What is that telling us? Well, that is telling us in the same way as the change in receivables is telling us that we have recognized more revenue than we have received in cash. So to get closer to cash, we subtract that. I look at this for the non-current assets as well, and add both of them together and take them off revenue, and you can see the revenue there is 36,974, or sorry, the cash that we've received from customers is 36,974 as opposed to the revenue of 37 billion, and there's not a huge difference there. If you looked at it over multiple years, you would probably see these figures. They fluctuate a little bit, but this kind of puts your mind at rest that the company is receiving something around the same cash as it's recognizing as revenue. If we had huge increases in some of these balances, if receivables were getting much larger and stuff like that, you would be seeing a difference between revenue and cash. Or if contract assets grew really quickly, then you would be seeing a difference between revenue and cash, and you might want to look into that further. Okay, so Vodafone, are there any significant management judgments in all of this revenue recognition? Well, there's the allocation of the transaction price between the phone and services. So that they say they use standalone selling prices. We've got to take them at their word on that. And then the recoverability of contract assets. So will we subsidize a phone and then be unable to collect service fees from the subscribers? If a phone company got really aggressive and wanted to grow really aggressively, I'm not saying this is the case with Vodafone, and they started to give very expensive phones with large subsidies and then not recover the cash flow in the future, well, that would be a problem. And we'd have to worry about that. It doesn't seem to be a problem in this case, of course. Okay. And this is another way of looking at things, another way of doing this analysis. We look at our revenue up here, which we just get from the income statement for the 2 last years. We add up all the various types of receivables. There's some long-term, there's some short-term, and we get a total for receivables, then divide that into revenue. It's about 10.5%. It's 9.7% the year before. It's grown slightly, but not in any concerning way. The same for contract assets. We look at contract assets, both the long-term and short-term, or current and non-current ones, divide them into revenue, and again the contract assets 7.9% here, very stable over time. So again, this gives us some reassurance that revenue recognition is actually working as it's supposed to. So a quick look at what kind of industries have contract assets or have large amounts of contract assets. The energy industry is the standout one here, with about 12% of a median value of 12% of contract assets. Why is this? Well, the energy industry has to provide energy to its customers and then usually bills them afterwards when the meters can be read and all the rest of it. So they end up recognizing revenue before they're able to bill the clients. So that's why they end up with a lot of contract assets. Capital goods, again, can end up in that kind of situation. And media and entertainment, they may provide media services or entertainment services and only get paid afterwards, or only be able to bill the client afterwards. Consumer durables, utilities as well have that same situation. So anywhere where you have provided the service, you have satisfied your performance obligations, and you can recognize the revenue, but you cannot bill the client, then you will have large contract assets if that's the nature of the business. Okay, so let's look at another reasonably complex type of situation. Again, this has to do with the provision of physical goods, but along with maintenance and service contracts. A jet engine manufacturer, I must have left a word out there, has a contract to provide a jet engine and 5 years of maintenance service to an airline that purchases that engine. What are the jet engine company's performance obligations? Well, the first one is to provide the physical jet engine, and that gets bolted onto the airplane or whatever. The second one is to provide maintenance service, and usually these services occur in terms of, they're episodic. They happen after a year or after 2 years or after 3 years. There are certain maintenance events that must occur. Now, the jet engine and services are distinct, the same as our last situation. You could buy the jet engine separately and then contract with somebody else to provide the maintenance service. So they are distinct. For the jet engine, we recognize revenue at a point in time when the jet engine is provided to the purchaser, to the airline. And the maintenance services are recognized when the performance obligations have been satisfied. So essentially, and this is important, this is when the service occurs. When we actually do the service on the engine, then we can recognize the revenue, because this used to be the same under older accounting rules. And this is Rolls-Royce here, and they are showing how the accounting has changed since the old rules, and I think it's instructive to look at this because it explains quite well what's going on here. Under old accounting rules, when you had a service agreement, see this blue line here? Essentially, you said, okay, we have a service agreement over 5 years. We will recognize it evenly over those 5 years. And the problem with that is, when you get into year 3 and you're doing some of these services, if the costs of those services were a lot higher than you expected, you've already recognized a lot of revenue. You haven't done much for it, and now you may be facing into a very low margin situation, or indeed losses on servicing the engine. And this is in fact what happened to Rolls-Royce. They had difficulties with the servicing of some of their engines, and the service cost was much higher than they expected, and they had fixed cost service contracts with the airlines, and they just had to provide the service even though the costs were higher. What happens now, rather than allocating the revenue evenly over the 5-year period, this line here, you can't really recognize much revenue at all until you actually carry out the service here. So once you carry out the service and your performance obligation is satisfied, then you can recognize revenue. So revenue is going to be more lumpy in this situation than it was in the past. The same revenue will be recognized over the service contract, but the timing of how that revenue is recognized is going to be different. So this could occur in lots of other situations, like a car company that provides servicing. You can buy 3 years of servicing for your new car, or something like that, or 5 years of servicing. Again, maybe in the past they could have released that revenue evenly over time. Now they can only do it when they actually service your car. That is a significant difference in these new accounting rules, or well, they're not new now, since 2018. So what are the implications of this example? Well, even if a service contract is paid monthly, as we've seen throughout this video, it doesn't really matter when you get paid. Revenue recognition is a separate decision. The company must wait until the service is actually carried out to recognize revenue. Payments will be a contract liability. So if we get payments in and we haven't actually done anything for them, they are an obligation. Well, they'll go into the bank, of course, but they will be an obligation until we actually provide the service and the performance obligation is satisfied. Revenue will be matched against the actual cost of carrying out the service, and this means there's less chance of recognizing revenue early when the costs are still uncertain, and there's better matching between revenue and costs of satisfying the performance obligation. Okay, well, a little bit of a change of pace here because we want to look at warranties and rebates. And warranties and rebates are not really dealt with in the same way as the revenue recognition situations that we've been looking at so far. Essentially, both warranties and rebates, you must make a provision for those. Don't go into contract assets or contract liabilities. You make a provision. So when you sell some goods that have a warranty associated with them, you must make a provision that of each 1,000 units that you ship, that 5 units will come back and require warranties, replacements, or service. And we'll deal with rebates. So let's look at another example. This is a car company that has a contract to provide a car and 36 months of warranty. So there's a physical product, the car, and there's also the warranty. The warranty is that the delivered car will work as specified in the contract. So this is just making sure that the car, any defects in the car are fixed. It's not providing additional services. This is what the standards call an assurance type warranty. What are the car company's performance obligations? Well, the first one is to provide the car, and we recognize revenue at a point in time when the car is provided. The second thing that we're providing in the contract is to provide a warranty, and this is within the contract, all right, but it's not necessarily a performance obligation, and we make a provision for the estimated warranty expense under the provisions standards, not revenue recognition. So essentially, warranties, what we get for warranties from the customer, never goes into revenue. So if we sell a car for €40,000 and we allocate, 300 euro of that to the warranty that we're providing, then we should not put that 300 euro in as revenue. We should show the car revenue minus the warranty revenue, minus the warranty as the revenue that we record for that car. If it was a service type warranty, then it would be different. If we were, providing some kind of extra benefits, then it would be different. Payment for warranties are not revenue. They don't go into the revenue figure. They are added to warranty provision, which is a liability in the balance sheet. As warranty costs occur, they are charged against the provision and don't affect the income statement. So as long as we are making sufficient provision for warranties when we sell the cars, and showing them as a warranty provision in the balance sheet, then we shouldn't get an income statement effect in the future when we actually have to perform the work on those warranties. So this is from Ford from the first half of 2024. And this is their warranty and field service accounting policy. We accrue the estimated cost of both base warranty coverages and field service actions at the time of sale. And they say they use an estimation model using historical information. We establish, again, the same thing. They're using some kind of analytics to work out how much warranty expense they're going to have. And sometimes they issue extended warranties, where there's a defect in a car and they need to do that. You can see here, this is their warranty provision here. And in 2023, the warranty provision was about 9 billion, and it's gone up to 11 billion. You can see there are considerable payments here to do warranty service, and the charges to the warranty provision have gone up considerably. It was 2.1 billion last year, 2.6 billion in 2024 for the first half of 2024. So what's happening here is that they're having to put away quite a bit more in warranty provisions. You can see here that in the second quarter of 2024, their margin is really reduced. Their earnings before interest and tax margin is really reduced, and the same for the first half of the year. And the explanation from that was that it was primarily driven by higher warranty costs, higher materials costs, and higher manufacturing costs. So they're having a warranty problem. Some of their products are not as reliable as they would like them to be, and they're having to make further provisions for warranties. So in this case, there is a significant management judgment, because they are in a situation where they're having to estimate future warranty costs. And if they estimate those costs as being too low, we could be showing higher profits now and lower profits in the future. So example 5, a car company has contracted to provide a car and 36 months of warranty. Again, the warranty is the delivered car will work as specified in the contract. The company also provides 3 years of free servicing as a sales incentives. So this is a different situation. This will be a separate performance obligation to provide the service over the 3 years, and we'll have to go through allocating the transaction price to now 3 parts, including the service as well. We recognize the car revenue at a point in time, and we recognize revenue at a point in time when the service is provided. And here is the policy. We defer the recognition of a portion of the consideration received because we have to satisfy a further obligation, and they use observable price to determine the standalone selling price. And if they don't have a standalone selling price, they use cost plus a margin, so they can work it out that way as well. Are there any significant management judgments? Not really. The standard has tightened all this up, so revenue from service is only recognized when the service is actually carried out, and they're going to know. So now I want to talk about rebates, and rebates are a similar situation to warranties in that rebates should not really go into revenue at all. Rebates are discounts that are given retrospectively, so after the event, based on actual purchase volume. So what happens here is a fast-moving consumer goods company will offer somebody like a supermarket a rebate of 5% if they buy more than 30 million units. Now the problem is that when we're selling the goods to these customers, we don't know, will they exceed this volume or not? And the purchaser pays full price at the time of sale, and they receive a refund or a rebate if they meet conditions at the end of the year or the quarter or whatever. Now, the accounting standard IFRS 15 calls this variable consideration, and it tells you must estimate this. You can't ignore it till the end of the year. You must estimate it as the sales are happening. The accountants can't simply wait until the period closes to record rebate income rebate expenses. Here, they must estimate the rebate value throughout the contract term. So revenue should be net of expected rebates to customers, and the amount of expected rebates is a liability, generally offset against receivables until paid to the customer. So a fast-moving consumer goods company supplies a branded detergent to a supermarket chain. They agree to grant a rebate of 5% of selling price if the supermarket buys 10 million units or more over a calendar year. So how should the fast-moving consumer good company account for revenue? They should estimate the amount of rebate that will be payable to the supermarket, and this amount should be excluded from revenue and included in a provision for rebates. And this is generally offset against receivables in the balance sheet. When the rebates are actually paid, this account will be reduced. So this is an example from Unilever, and what I've shown you here is the key audit matters discussion about rebates. And you might want to pause here or come back to this point in the video and have a careful look at this. We will just look at this paragraph here. Certain discounts for goods sold in the year are only finalized when the precise amounts are known, and revenue therefore includes an estimate of variable consideration, and the variable consideration represents the portion of discounts that are not directly deducted on the invoice and is complex as a result of diversity in the terms in contractual agreements with customers. So a big company like this could have all kinds of different rebate agreements with different customers. And what they're telling us here is that, this is something that auditors worry about. And this is what they do. They evaluated and tested the operating effectiveness of certain controls related to the revenue process. Essentially what they're trying to do is they're trying to make sure that the company has correctly estimated rebates for their customers. And they'll be doing this by looking at what is the evidence behind the rebate calculations. Is Unilever looking at data in relation to, okay, the company's halfway through the year, does it seem like it's going to be able to achieve this rebate or not. And this is Unilever's receivables. And this is their trade receivables. So what's owed from their customers, 4.2 billion. And down here you can see included within trade receivables are discounts due to their customers of 2.5 billion. So of that, 4 billion, we have to add on 2.5 to get like the book value of receivables. But of course, that's probably not going to be paid as long as Unilever's estimates are good on that. So I guess the message here is that rebates don't go into revenue either. Like warranties, we make a provision for them. We don't show them in revenue and then deduct them somewhere else. Okay, and I might also just mention discounts. Discounts shouldn't go into revenue either. Revenue that you see in the income statement should be net of discounts. So revenue from physical goods is generally recognized on delivery or transfer of control to the customer. Fairly straightforward. And how do we handle this? Well, analyze receivables and its relationship with revenue. We don't, for physical goods, we don't have complex revenue recognition problems. Additional services are generally a distinct performance obligation, and revenue can be recognized over time or at a point in time. Warranties, discounts, and rebates are provisions. We make provisions for them, and they should never make it into revenue in the first place. Okay, so thank you very much for watching this video. This is the second in a sequence of videos about revenue recognition. The next one is about services revenue, and the one after that is about contract revenues. Please like the video and subscribe to the channel if you're interested in this content and you're interested in seeing more of this kind of content. Thank you very much.